Hello, this is Professor Hazer again, and this is the second in the videos in the what I call the final exam preparation problem. Okay, in the last video I did all these calculations here, and I read through the problem, did all those calculations there. In this video, I'm going to go ahead and do the normal consolidation calculations. Okay, so it's a 90% acquisition. So we'll do the fair market value first, and the goodwill and the income from sub, and we'll do the investment account. Keep in mind that the acquisition took place on 1/1/16. That's when you calculate the goodwill, but the consolidation is for 2020, so it's a fifth-year problem. Keep that in mind, please. Okay, so fair market value. Going back to the text of the problem, the cost of the acquisition is $15 million for a 90% acquisition. So this is going to be 15 million, and it's all in thousands, so I'll leave the zeros off. So this is going to be equal to 15 million divided by 90 is going to give you a perceived fair market value at 100% of 116,667,000 basically. Okay, so that's your 100% column here. Okay, let's just go down the 100% column. At the date of acquisition, going back to the first paragraph here, the stockholders' equity consisted of 5 million capital stock and 2 million in retained earnings. So that's 7 million. So I'm going to take out 7 million there. And I'm going to put it here just to mark this. I'm just going to put 5 million capital stock plus 2 million retained earnings. So that's minus 7 million. Okay, so the difference here is going to be rather large. It's 9.67 million, something like that. Okay, then there's two items that were undervalued, so you're going to subtract them. The fair market value is greater than the book value. Okay, the first one is $500,000 undervalued inventory, and you go to the last sentence there, and 3.5 million undervalued building with a 7-year life. Okay, the inventory obviously has a 1-year life. We've always said that. Okay, so the inventory, this is going to be minus, this is equal to minus $500,000, I think it was. What's my number here? 500,000, and the building is minus 3.5 million. So this is minus 500,000, and the building is minus 3,500,000, and I'll just leave 3.5 million, 3 million, and I'll leave this at minus 500,000. Okay, so your total goodwill for the entire company is going to be 9, the sum of those three items right there, which you're going to have goodwill of 5,667,000. Okay, so the only thing left in this calculation is to break it down between 90% and 10%. I'll do the 90% column first. Okay, so the goodwill, the numbers are correct. I'm looking at a sheet here, obviously. The goodwill for the 90% column for the controlling interest is 5,100,000. Okay, then in the 10% column, we're going to have see what our goodwill is for the 10% column. Ultimately, no. Okay, so our goodwill for the 10% column is 5,667. That looks correct. And the last thing I'm going to do is get down, is compute our amortization numbers. Well, the amortization for the goodwill has a 1-year life, obviously. And I'll put a year here. and the building has a 5-year life here. So I'll put 5 here, 5, and then years. Or excuse me, the building has a 7-year life, so I'm going to make that 7. Okay, so obviously, so the inventory is going to be divided by 1 because it's a current asset, so it's always going to have a 1-year life. So these are just the expense amounts. Okay, so those are the expense amounts that will move down into the income from sub calculation. And here's the expense amounts for the building. For the full building, it's 3,500 divided by 7 years. These are the ones that count. So 500 total for the majority, for the controlling interest, is equal to 3,150 divided by 7. And for the non-controlling interest, it's going to be 350. Gives you 50 there. Let's go ahead and stretch this out a little bit. Okay, those numbers look correct. Okay, let's go down and move into the income from sub. This shouldn't be too bad. Okay, now as usual, we're calculating 2020 income, so get the income from the sub's current income statement, which is way down here on the consolidation. But you can't go wrong. There it is right there. Sub's income for this year is $2,000. $2,000, and we'll put the same number here. Now we've got 2 items, intercompany transfers, which can affect this year's income. First of all this inventory item from last year, this is leftover gross profit from last year on inventory that was sold this year to a third party. So this is going to affect this year's income, as well the 120 because it's occurred in 2020. So there's 2 items right there. And then this equipment transfer took place. This is the upstream item, which took place this year, and it's upstream, and it took place this year. So the income is going to be affected both by the gain that shouldn't be there and by the excess depreciation, which shouldn't be there. Now, this is on the test, but upstream transfers, I don't care if it's inventory, equipment, whatever. Whenever there's an upstream transfer, since it's sold by the sub, from the sub to the parent, you're going to have to split it above the percentage here. So if the inventory had been sold upstream, you'd also have them above the percentage. So I'm going to put 0.9 here and 0.1 here. Those are going to be your percentages. So whenever you have upstream items, you have to subtotal above the percentage and split them. And the reason is these are sales from the sub to the parent, and the sub is owned 90%, 10%, whereas the parent is not. So anything that happens to the sub has to be split 90-10, including intercompany transfers. Okay, so and what are we going to do? The sub recognized a gain that shouldn't be there. That overstates your income, so you got to pull that out. But then the parent records too much depreciation. That's excess depreciation. So you've got to back out depreciation. Too much depreciation decreases your net income, so you've got to add back the depreciation. So take out the gain, add back the depreciation. Okay, so we know that the gain on this was 800,000, so we're going to have to back that out, and we're going to have to add back the excess depreciation, which is equal to 200. That's equal to 200 here. Okay, so since these are upstream, you have to start with the income, net out the upstream items. Even if they had been inventory, you take the adjustments here if they're upstream. It doesn't matter what it is, but you have to take them before the percentages. Okay, so your subtotal is going to be 2,000 plus 800 plus 200 gives you 1,400. This is kind of your upstream adjusted, your subtotal adjusted for upstream items. Then you got that right there, and then you take it times the 90% and the 10%. So we've got 1,260 for that number, and we've got for the controlling interest, and we've got 140 for the non-controlling interest. Now for the downstream items and for the undervalued building. Okay, let's do the downstream items first because we're doing under intercompany transfers here. So for downstream items, if they're downstream, always take the full thing in the parents column. And why? Because these are sales from the parent to the sub, and the parent's ownership is not split 90-10. The parent is kind of whole, so that's why we take it down. We don't split it. Okay, now you always add back beginning inventory, intercompany deferred gross profit, because it's profits being recognized. This is profit that have been deferred from last year on sales that have not been sold to a third party. This year they're sold to a third party, then you recognize it. However, the ending inventory, I'm going to put a minus there. I'll put a minus there, is always subtracted out because this is inventory which at the end of this year had not been sold to outside third party. So this is going to be equal to the negative deferred gross profit of, I believe, 120 up here. There it is right there. Okay, and now all we have to do is take our undervalued building. Our undervalued building is minus 450 for the controlling interest, and minus 50. What am I doing? Is equal to minus 500. Took the wrong row there. Minus, it's the same number to turn out. Okay, so it's minus 450 for the controlling interest. Let me get this right here. But you're taking that number there, and you're taking that number there, and I get that number there, and that number there. Make sure they're out of the building row. Okay, and that will wrap up our income. So you're going to take the 1260 for the building, and you're going to net out all these additional items here. So your income for the controlling interest is 790, and your income for the non-controlling interest is 90. Now, why didn't I take the inventory here? Because it's 1 year. However, the inventory, the undervalued inventory, going back to the original paragraph, was sold in 2016, so that inventory is long gone. So I wasn't trying to trick you, but I'm trying to emphasize that if it's a multi-year consolidation and you're past the second year, you're 3 years out, 4 years out, the inventory has been long gone, so this will be zero and it doesn't affect the income account. Anyway, so there's your income account. And then finally, here's the investment account. Okay, keep in mind that we're doing the investment as of December 31st, 20, and the balance, and so we're going to take everything above the line. It's going to be as of 1/1/20, and the balance at the end of the year was 12/31/20. Okay, so we're going to start with common stock. Okay, so common stock, let's just go ahead and take that from the balance sheet. Now we know that our assumption in this class is the common stock doesn't change. There's no treasury stock or anything like that. So the sub had $5,000 common stock to start the year. We're assuming it's always. Okay, we'll split that 90-10 later. Now the retained earnings, don't take the retained earnings from the Texas problem because those are 5 years ago. Take the retained earnings from this year's statement of retained earnings. Those are $4,000. Okay, the goodwill we know is 5667 at 100%. And then we've got two intercompany items. Now this is why in the last video I emphasized when you have intercompany items, distinguish between those that took place before this year and ones that took place after this year. If everything above this line is before this year, anything that happened during this year doesn't affect that balance. It couldn't have happened because this is balance as of January 1st, 20. Anything that took place after that can't have affected that balance. So there's only two items that took place after this year. One is the deferred gross profit on the beginning inventory. So that's 100. And I'm going to do that again because that should not be a negative. Excuse me, that should be a negative. And I'll explain why in a second. So beginning inventory is always in your investment account as a negative. The ending inventory can't be in there because it hadn't happened as of the beginning of this year. And then we're going to take out minus the gain on the sale of land that took place in 2017. Okay, so we'll take that out. Gain on the sale of land was 500. Okay, the reason I'm taking the inventory out is because at the end of last year it had not been sold by the sub to a third party. It's a current asset, so this year it will be sold, but as of the beginning of this year, it had not been sold. The reason we're taking the land out is because in 2017, this was the upstream transfer, no, this was a downstream transfer. The parent has sold the land to the sub, but the sub still hasn't sold it to an outside third party, so that will stay in there as a negative, because in 2017 you would subtract it out because it had been sold to a third party. It still hasn't been sold, so you're taking that out. In a sense, these are very similar items, but inventory will be sold this year, so that's why we added it back to net income. The reason we didn't add back the gain to net income is because it hasn't been sold to an outside third party. Inventory is assumed because it's a current asset that is sold to a third party. Land is not, obviously not a... okay, so we're going to split these 90, 10. We're going to split this 90, 10, and then we're going to split this, all these 90, 10. Goodwill is split 90. The building is going to be split 90, 10. I've already got the 150 in there. Now, these are both downstream items. You notice that the income calculation for both, for the inventory, the land's not in there because it doesn't affect 2020 income. It was a 2017 transaction. But the beginning inventory is a downstream item, so that will wholly be just affect the 90% column, and then the gain on the land was a downstream item. Now the reason we're taking it out is because it hasn't been sold to a third party at the beginning of this year. Now it has a beginning inventory. This is a balance sheet account, so it affects the inventory affects your income because that was income for this year that was misstated, but the income on the land was misstated back in 2017. But from a balance sheet perspective, those items are still sitting there at the beginning of the year. So until you sell them, they'll be there. Inventory will be assumed sold, but the land hasn't been sold. Okay, so we'll sum up these items to get our beginning balance, which is 13,950. That looks good. And we'll sum up these items to get our beginning balance in the 10%, which is 1617, and that looks good. We'll just move our incomes down. 790 and 90, that's already been moved down. Let's, for posterity, go ahead and move it down again. Now dividends. We're going to split dividends. Get your dividends for 2020. That was the current year. Get those from the statement of retained earnings for this year. There they are right now. And it was negative already stated, so I don't have to put a negative there. So it's 100, and we'll split those 90%, 10%. Okay, so your investment account should have 14,650, and your non-controlling interest is 16,790. So there's two items we have to match. Let's make sure that the income is 790 at the investment account is 14,650 on the income statement and balance sheet respectively. 790, there's your 790 from the equity method, and there's your 14,650. They match, so far so good. The next video I'll do the journal entries, and then the last video I'll do the consolidation. Those should be short videos. Anyway, I'll be posting these today. This is Friday, December 11th. Okay.